Hey there, welcome back to Finance and Sticks. And if you've been following the playlist, this is the fourth video. In the last episode, we talked about risk tolerance, knowing how much risk you're comfortable taking. Today, we're taking the next step, understanding the different types of investments and their risk level. Because before you invest, you need to know what you're actually investing in and why. Let's break it all down. What is an investment? An investment is simply putting your money into something with the expectation of getting more money back over time. But not all investments are created equally. They come in different types, with different levels of risk and reward. Let's look at 7 common types of investments. Let's go over the 7 most common types of investments you should know about. 1. Stocks. When you buy a stock, you're buying a piece of a company. If the company does well, the stock price goes up and you can make a profit. But if it performs badly, you could lose money. It offers high return potential and higher risk level. 2. Bonds. A bond is like giving a loan to the government or a company and they pay you back with interest. Bonds are considered safer than stocks, but usually have lower returns. It's more stable and lower growth. If you are the type that cannot handle risk, investing in bonds is a good option for you. 3. Mutual funds. Instead of picking individual stocks or bonds, mutual funds and ETFs let you invest in a mix of assets all at once. Great for beginners because they provide diversification. This type of investment offers lower risk through variety. Management fees may apply. 4. Real estate. Buying property, either to rent out or sell later. It's a powerful way to grow wealth, but it requires more capital upfront and hands-on management. It offers steady cash flow and long-term growth. It is high cost. 5. Digital currencies like Bitcoin and Ethereum have exploded in popularity. They offer huge upside, but come with serious risk and volatility. It offers high potential returns and it's extremely risky, not regulated. 6. Commodities. This includes things like gold, oil, and agricultural products. They often move in the opposite direction of stocks, which is useful during inflation or economic downturns. It's good for hedging risk and prices can be unpredictable. 7. Savings and fixed deposits. These are the safest places to keep your money, like bank savings accounts or fixed deposits. They offer little to no risk, but also low returns. It's very safe, but can't beat inflation over time. Which investment is right for you? Each type of investment has its pros and cons, and the right one for you depends on your risk tolerance. Remember video 3. Your goals, short-term or long-term. In your knowledge, do you understand the asset you're investing in? For example, want steady, low-risk income. Bonds or savings might be best. Looking for long-term growth. Stocks or real estate could be for you. Feeling adventurous? Maybe explore crypto, but only with money you can afford to lose. 4. Diversification matters. One last tip. Don't put all your money in one place. Diversify your investments. That way, if one goes down, the others can help balance it out. A smart investor spreads risk and stays consistent. Now that you know the different types of investments, you're one step closer to making smarter money moves. In the next video, we'll cover how to build a beginner-friendly investment plan. Make sure to stick around. Hit that like button if this video helped you. Drop a comment on which type of investment you're most interested in, and subscribe if you haven't already. This is Finance and Sticks, where we break money down in simple terms. Catch you in the next one.